This is the Forecast Free series from the Resilient Advisor podcast. Today is November 20th, 2019. My name is Jay Coulter. My partner in this project, as always, is Clint Sorenson, the Chief Investment Officer at Wealth Shield. Now, I've been fortunate with this podcast. Thanks to you listeners and great series partners like Clint, we've developed quite a following. In fact, the podcast has recently been syndicated by Advisor Hub. If you've enjoyed or found benefit in the podcast, would you please consider rating the podcast on iTunes and writing a short review? It would really help us. And if you send me a screenshot of your review, I'll send you a copy of my book, The Resilient Advisor. Just send a screenshot of your review as well as your mailing address to podcast@jcoulter.com. That's podcast@jcoulter.com. Clint, let's get to it. I love Wealth Shield's daily note. It's must reading for me in the morning. I want to read something from this morning's note that you wrote. Let's join together and thank global central banks and U.S. corporations for QE and not QE and unlimited corporate buybacks so that we could all enjoy a great bull market that stretched valuations to extremes and robbed future generations from any return out of any public asset class without a market collapse. Big time statement, Clint. Unpack that thing for us.
Yeah, absolutely. So, what happened was John Hussman, who I think who does probably some of the best valuation work. He's known as a perma bear, and I'm not going to dispute or argue with that label. Although I wouldn't label him that. But at the end of the day, he does really, really great work on the valuation front. And what I found was a chart he had posted on Twitter that just showed the 60-40 portfolio based on current valuations and obviously level of bond yields. And then what he did was he just overlaid that with what forward returns or expected returns should be based on those valuations. And when you look at that chart, the two lines are mirror images of one another. They look identical. And what it implicitly says is that we're going to have low average returns for the next 12 years in a 60-40 portfolio. And that's largely driven by stock market valuations, but also low nominal yields. And on our trend report yesterday, we posted a very similar thing from Research Affiliates Expected Returns, which is based on the cyclically adjusted price to earnings ratio. And essentially what you see there is valuations have been pushed because prices have been pushed up by a lot of these other factors that have caused the market to run on a price basis, but the fundamentals haven't kept up. So whether it's earnings or GDP from an economic standpoint or gross value add, it hasn't kept up with the rate of price increase. And so you get these disconnects from a valuation perspective. And I was just calling attention to the fact that a lot of that has probably been driven by corporate buybacks and by quantitative easing and global central banks buying equities and buying fixed income that unbelievable. It's really unprecedented, right? We've never seen this before. And when you look at that, and you see what that actually does, and it just pulls returns forward to present day to restore confidence in the financial system. What it does in turn, without a market collapse, is it essentially says that forward returns are going to be a lot lower, right? Because if I pull them all forward, that means, looking out 10 to 12 years, I've got low expected returns. And so without a market collapse or without prices really dropping or without the denominator really rising, so GDP or earnings or whatever that denominator is in the valuation multiple, without that going up a lot or prices coming down a lot, expected returns are going to, should be pretty low or a lot below average, unless this time is different.
So Clint, I feel like we've seen research like this talking about, forward returns giving stretched valuations for the past 60 months, maybe. So folks that have taken that to heart and reduced equity allocations as a result have really missed out on a lot of the market expansion here. And really net, and you talk about this in today's note, it speaks to the death of the 60-40 model. So what should an advisor who's allocating to portfolios new money today, what type of strategies could they look at given where the valuations and equities are today? What considerations should they make for their portfolio construction?
Yeah, I'd like to just start off by saying valuations are not a timing tool, right? If they are, they're a long-term timing tool. So meaning as soon as the market gets overvalued, and by our definition, that would be, let's say, valuation multiple getting in the top decile. When that gets in the top decile, and we're not going to say, hey, go out and start reducing equity for a 3 to 5 year time horizon return adjustment, right? So we're not going to expect anything beneficial over that. when you adjust a portfolio on valuations, you're saying my next 7+ year return is going to be X, right? Or should be X based on history. And so that's really one of the first issues is when an advisor or a private client looks at these valuation indicators and they go out and they say, hey, we're going to reduce equity, we're going to sell and essentially reduce risk in a portfolio. Well, you've got to be prepared for a long time before that mean reversion, right? Because mean reversion takes on average 12 years. So it's very hard to time using market valuations. So if I was an advisor, the way we do it using valuations to say, hey, we're at high valuations in the US. What other areas of the world could we allocate to? Obviously within the behavioral confines of the client and their unique goals, objectives, and constraints, et cetera. And their biases, right? Because if they're home biased, we don't want to put them too much into emerging markets, for instance. But with all that being equal, we would look at where are the opportunities elsewhere to allocate, and then we'd start incorporating those into the portfolio. We also use market sentiment measures or trend to say, hey, we're still comfortable holding, let's just use US stocks at high valuations if the trend's up, right? If it's performing better than the risk-free rate and it continues to make new price highs, at the end of the day, the market is right in that scenario, and we're going to continue to have that as a tactical portion of a portfolio. But we would look elsewhere. So right now, emerging markets are priced for the highest returns. If you look at just a CAPE measure over the next 10 years, you've got European private equity. There's international assets are next. And then there's a cluster of assets below that expected 2% per year annual real return. So, you have to get creative here. And another way we use this, we might start looking at alternative investments. So we might start looking at private real estate or global macro funds or long short. There are areas where hopefully there's some value add still left, from a manager capability standpoint.
So as far as the death of the 60/40 model, it's the death of taking the dogmatic approach of just having a US-based allocation for your equity exposure, looking overseas. Right now, you see opportunities in emerging markets, potentially private equity in Europe. What did you mention? European public equities. Where do they sit?
Yeah, international developed it's a little bit under from an expected return perspective of emerging markets, but absolutely. And over the last 27 weeks, hedge funds have been buying European stocks, 25 out of 27. We're seeing some of the PMIs improve to the upside. Some of the economic data starting to show some quote unquote green shoots in Europe. So might not be a bad place to start looking. Some of those areas have a lot better valuations than here in the US.
So, Clint, I think this is very timely for advisors here as we approach the end of the year. It's time for some tax loss harvesting and reallocating those funds to those types of alternative assets could provide opportunity, as well as, public equity exposure over in Europe. I want to wrap up with the top 3 things from your note today that have your attention. The first is copper. What are your thoughts?
Yeah, so copper and a copper gold ratio are really diverging from equity prices and the whole global reflation trade narrative. So copper tends to rally when the economic environment is in an acceleration. So global economic environment, it's really driven a lot by China. And so what we have is we have the market betting on this reflation trade over the last several weeks, right? That maybe the economy isn't going into a recession. I mean, if you look at Google search terms, people weren't searching for recession as much. Very interesting how quick sentiment shifted, even from a market optimism standpoint, on this whole narrative that maybe the economy is not as bad as we thought, and that we're going to go into this global reflation trade. Copper's not telling us that. So copper was up a lot yesterday, which was nice, especially in the face of some I guess, challenge to the whole rhetoric that we were going to have a trade deal, right? With Trump saying that he would lift tariffs if we didn't get one done, and then Senate passing that bill that kind of backed Hong Kong protests and really angered China. So seeing copper rally on that yesterday was nice to see. However, copper remains in a downtrend, which tells us that growth is still slowing from a global economic perspective. And as long as that's the case, you don't want to be underweight equities necessarily, but we'd want to be in the more defensive factors and sectors in the equity market.
Well, and maybe that speaks to your second point in the note that you're looking at. TLT had a strong day yesterday. Without forecasting, what are the implications there?
Yeah, so TLT, essentially what we're looking at that's just the inverse of rates, essentially, right? So it's the long-term treasury bond. It's a measure of a risk-free rate, good alternative to other asset classes. So we look at that as kind of the purest representation of a defensive posture. And as long as rates are coming down, we expect TLT to continue to move up. And so what it's been doing is it made a new high in September, a new all-time high. It was really trending very strongly over the course of the year. It's still above its 200-day moving average, just consolidating in like a triangle or a wedge pattern. And so what that tells us is that there's some indecision about the next direction of rates. And really the question is, it comes back to the economy. Will we reaccelerate? And if the economy really does go into this global reflation trade, then you should have rates move up and TLT move down. On the flip side, if we continue to slow, right, and maybe the consumer catches down to manufacturing contraction, maybe globally we are just seeing a stabilization before the next leg down, then we would expect TLT to move up and rates to continue to move down. And so, it's hard to forecast that, but measuring the data where we are on a rate of change basis, we would expect rates to continue to come down, and we would expect growth to continue to slow, because that's what it's doing now. If that changes tomorrow, I will change my mind, like Mr. Keynes is famously quoted.
All right, and then lastly, yesterday we saw the housing starts and building permits numbers go up, yet the home builders dropped. Counterintuitive. What's going on?
Yeah, so it was counterintuitive, but again, it shows you that the market may be a discounting mechanism, right? So at the end of the day, maybe that's why home builders have run up and been such a strong sector this year, is that they kind of front ran the improvement that we saw in the housing market. Because housing was one of those early leading indicators last year that clued us into a slowdown economically, right? Housing and housing-related good consumption's roughly 40% of consumption here in the U.S., and consumption is about 70% of GDP. So if you get housing right and housing-related consumption right, so housing goods, then you can get the consumer right. So that's a really important piece. And seeing that housing was really improving earlier this year and really into late last year started the improvement was encouraging, right? So maybe we'd get some support from the consumer. However, home builders kind of front ran that and have run up against their all-time highs, which were early 2018 highs, and are kind of testing that resistance level. If they break out from here, that would mean that we're, in my opinion, we continue to see some improvement in the housing market. And what we've seen in lumber recently, especially lumber to gold ratio, suggests that we'll continue to get some support out of the housing market and some demand.
Well, I tell you, Clint, subjectively, I'm in Atlanta, and they are building houses in every vacant lot that they can, and you cannot find a house to buy. But just my subjective analysis here in Atlanta, it is not slowing down at all. Listeners, if you would like to subscribe to Clint's Wealth Shield Daily Market Update, please visit wealthshield.co. That's wealthshield.co. Clint, thanks for coming on.
Thanks, Jay.
The information provided is for educational and informational purposes only and does not constitute investment advice and should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult an attorney or tax advisor. Resilient Wealth LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Resilient Wealth and its representatives are properly licensed or exempt from licensure. For Resilient Wealth information, please visit Investment Advisor's public disclosure website at www.advisorinfo.sec.gov by searching Resilient Wealth CRD number 301986.